people who are wondering what this means for their credit card bills, how should they be bracing themselves for this period?
I spoke yesterday to someone from the retail industry who gave me a sense that the consumer is already adjusting to some extent, and that most of the spending in this particular chain of stores is on essentials, not on discretionary items. And I think that's probably what's happening. The overall consumer numbers are holding up, but the constitution of consumption is shifting to essentials. And I think you're going to see particularly those at the lower end of the income spectrum doing that more and more, and with more and more difficulty, frankly, if essentials continue to rise in price.
And Dennis, real quick, I guess just your reaction to the market's reaction to this. And I know you're more of an economy guy, not so much an equity person, but when you take a look at the euphoria that we continue to see in the markets when the Fed is still saying that they're going to raise rates, it just might not be as aggressive. Do you think a move like this is justified?
Now, we'll see if it holds for the next couple of market sessions, but I think what you're seeing right now, and the Dow is up, 202 points, is sort of a sigh of relief mini rally after a lot of suspense building up, or not so much suspense, but let's say just building up to the decision and the announcement by the Fed. And I think what the Fed has done today, as well as has said, sort of confirms the expectations that were already priced into the market, and the market is responding positively to having their expectations affirmed.
The markets are walking through a desert searching for any hope that there might be water on the horizon, aren't they? Dennis Lockhart, great to have you here, sir. Appreciate that.
Thank you.
All right, joining us now for a closer look at the bond market reaction, RJ Gallo, Federated Hermes Senior Portfolio Manager. Good to see you, sir. Let's first get your reaction. We knew the 75 was coming. Anything inside the language surprise you, in particular the mention of the lags with which monetary policy affects economic activity and inflation?
Well, I think you and all the prior guests who just spoke before me are focusing on the right things. That the addition of that language elevated the importance of the idea that when you get closer and closer to a destination, you slow down, just like when you're driving a car. And that's what they're telling us. The acknowledgement of the lags, the cumulative tightening that's in the pipeline, the signal is clear. They're getting closer to their pause. It'll probably be early to mid 2023, call it 475 or 5. And then they have to stop and wait to see the cumulative impact of the tightening. The fact that the bond market is reacting with the steepening, where 2- and 5-year yields are double digits richer, makes some sense. This new language, I think, forecloses, at least for now, the concern that they're going to keep going 75. And I think it affirms expectations that were built off of recent FOMC members' speeches and appearances that this day was coming, this idea of slowing the pace and getting closer to the pause.
But RJ, when we're getting closer to a destination, I'm looking down at my GPS and I'm seeing the time go down 10 minutes or so. We're not seeing that in inflation. We're still at a 40-year high. What evidence is there that we are closer to the destination, which is 2%?
I'm going to stay with the car analogy.
Okay.
If you are going to drive your car by looking solely in your rearview mirror, you will hit a wall or another car. That's what the Fed would be doing if they looked solely at CPI and PCE, realized past inflation, while driving the car of monetary policy as the economy moves forward. They need to look forward and anticipate. It's undeniably clear that monetary policy is not instantaneous. Mortgage rates have surged, but other interest rate sensitive sectors are only now starting to feel the pain, the cumulative impact of a sharp and aggressive tightening that is already underway. They need to look through the windshield as to where the car is going. Lags take time to overcome. We cannot set policy solely on realized past inflation. The Fed is heartened, by the way, by the fact that inflation expectations are all pretty much south of 3%, whether you look at tips or you look at surveys. So they are acting in a manner that keeps those expectations relatively contained, and they can't set policy solely on realized inflation. It's like driving a car looking solely in the rearview mirror.
So RJ, then, in terms of what we saw with Q3 real GDP, obviously we know that the Fed is data dependent, but with so many different indicators pointing in different directions here, what does this mean for not just the likelihood of a recession, but how deep of a recession we might be headed for?
Q3 GDP was an upside surprise propelled heavily by the surge in exports and the drop in imports. The post-pandemic world has been dominated by heterogeneous reopenings, all kinds of distortions to global trade patterns. Who actually thinks exports are going to keep growing at a double-digit rate? Very few people. The economy is slowing in China. The economy is likely going to be in a recession in Europe. Global growth is slowing. Our exports are not going to continue to expand that pace. If you X out the impact of trade and government spending from the Q3 GDP release we just had, it was 0.1% at a seasonally adjusted annual rate. 0.1. That wasn't that strong of a GDP print. The underlying internals, when you X out trade in particular, as well as government spending, are weaker. The midterms are coming up. Government spending is not going to be surprising to the upside when we have divided government with Republicans controlling perhaps the House and the Senate, certainly the House.
RJ, certainly when you take a look at the market's reaction, they're not waiting for the press conference just in terms of how they are interpreting this additional sentence that was put into the statement. But when we look ahead to that press conference from Fed Chair Jay Powell, what are you hoping to hear? What will you be listening for over the next 45 minutes or so?
The new language that we've all been talking about is going to get questions from the media that's assembled in the room there. They're going to want to drill down for further meaning there. It's a challenge that Chairman Powell faces getting in front of them at any session, but he actually has a unique challenge now. This language, which I think was unanimous across all the voters, suggests that they're opening the door to the pause. It's not right away, but we're getting close. We're getting close to our destination, as I said before. There's going to be a lot of questions about how the market should interpret that new language. Why was it put in there? Clearly, the committee, on a unanimous basis, feels like it belongs there. Can Chairman Powell still sound hawkish on inflation while acknowledging the need for a pause and not open the door to a huge rally? Former President Lockhart mentioned it earlier. It's a tough act. It's not an easy task to communicate such subtleties to the markets, which often trade on sound bites. So there's the risk that he gets up there and tries to talk back or walk back the language in the statement. That seems like a low risk. I think he may elaborate on it in a way that will get further bullish response from potentially equities and from the intermediate part of the Treasury curve, for example.
So then, RJ, on behalf of investors, if you were in that room with Jay Powell, what would you want to ask him?
Interestingly enough, I think that the bigger questions come down to quantitative tightening, the Fed's plans with respect to the balance sheet. They've made their pace of balance sheet reduction abundantly clear. But there's plenty of talk, including talk at the Treasury Department, of the need to sort of bolster liquidity. Bond volatility, both implied and realized volatility, has been extraordinarily high this year, and liquidity conditions have likely something to do with that. I'd be interested to see what Fed staff at the Federal Reserve Bank of New York, working with the Treasury, what they're thinking about, what measures could be taken to allow the balance sheet to shrink to be consistent with the overall monetary tightening, but to do so in a way that might be less disruptive to the functioning of the marketplace.
RJ Gallo, always great to have you. Federated Hermes, a senior portfolio manager. Thanks so much for joining us this afternoon. Let's kick it over to Jared Blickery as a closer look at some of those gains that we're seeing, at least across the board when it comes to the equity markets.
Yes, and don't
in the U.S.
In the U.S. And don't call it a pivot. Some great commentary there. And I'm going to delve deeper into this, but I just want to point out the Dow, S&P 500, NASDAQ, all in the green now, not the case earlier in the day. And I just want to go over some of the movements in the bond market. Here's a 5-year T-note yield. It is net down 9 basis points. You're going to see everything down on their yield curve. 10-year T-note yield, that's down 5 basis points. And the 30-year on the long end down a little bit less, 3 basis points. The very short end down 3 basis points. You can see the 13-week, that tracks what the Fed benchmark is doing, the very shortest end, and it has recovered somewhat. Also, the U.S. dollar, very important. That has taken a leg lower. But you got to think, all of this was set up by that Tim Rouse article in the Wall Street Journal about 2 weeks ago, and there's a lot of pressure on Fed Chair Powell right now. Is he going to deliver what he doesn't want. Is that going to be a stock market rally? The Fed officials have been on record saying that's not what they want to see in this instance. So I have to agree with our prior guest. It's going to be a very difficult tight wire act for Jay Powell to navigate here as he takes questions and isn't too bullish or optimistic. I guess we're going to have to apply the Goldilocks test with 2020 hindsight here, guys.
Has to be just right indeed. Jared Blickery, thank you so much. All right, well, as we await comments from Fed Chair Jerome Powell, let's bring back Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager, and Sarah Howes, Wells Fargo Senior Economist. So, Sarah, obviously we're seeing increased market reaction here, but obviously we're still waiting for the exact wording to come from Fed Chair Jerome Powell. Just how tough is this balancing act going to be in terms of the wording of this?
Well, I think it's still going to be very tough because I think he's going to want to demonstrate that the committee is still very much committed to bringing inflation down, restoring inflation back towards its target, but also acknowledging the fact they've done a lot of tightening to date and it's time for things to slow, but they haven't given up on that inflation target. And so as some of the prior guests mentioned, I think it's going to be difficult to make sure that the market maybe doesn't run away with that somewhat more dovish message than the Fed has been signaling over the past few months, but balancing it with the fact that, yes, there's been a lot of tightening to date, but there's still a lot of work to do when it comes to inflation.
And Joanne, perhaps Lloyd Blankfein, the former chairman of Goldman, tweeted it best. I imagine Jay Powell and the rest of Fed governors are right now sitting with the thesaurus trying to find the right word that means pause or not pause, depending on who's listening. So what's the language you'll be listening for? What's the Fed drinking game, coffee, if you will? Is it data dependent?
Yeah, who knows what thesaurus they're using, but data dependent is a term I'm sure we will hear again. I think they will get into specifics to try to create that balance. One area is to be clear that house prices went up a lot, renters is up a lot. That's going to feed into keeping inflation on inflation. The labor market remains tight. They could cite the recent data on that. On the other hand, they are also likely to cite data that shows that the economy is slowing a bit, whether that comes from the liquidity constraints that we are starting to see pop up in corporate debt markets, government debt markets. We're seeing credit spreads widen. We're seeing bid-ask spreads widen. So there's clearly a liquidity constraint that should tamp down some of the economic growth that we've been seeing. They can cite that as the other side, that their policies are having an effect, but that they need to do more, that there's definitely more work to do given the pressure on wages, given the housing data. And so I think they'll have enough data in their arsenal to be able to strike that balance. I think they'll try to emphasize, that they are data dependent and that looking at inflation in the past, is only part of the data that they use, that they're doing a lot of observation of the economy in real time to gauge how much more work they have to do. And if, again, you look from an investing perspective, I think it's pretty clear there are fewer rate increases to come than we've had to date. And that does suggest a little bit of less of a headwind to stock valuations going forward from here. And I think that's partly what the market is reacting to.
And Sarah, in addition to the inflation data, obviously the CPI prints, the 5 prints that we're going to be getting out between now and the next meeting is going to be a big focus. What else, in addition to jobs, will you be focusing on over the next 4 weeks?
I think consumers.
Go ahead,
I think
Sarah.
consumer spending, in addition to just the labor market and inflation data. So we've seen weakness in business investment. We've seen weakness in residential investment. As RJ was talking about, we can't see the strength in exports go on forever, but how the household sector does, how willing it is to spend down the savings, lean on its balance sheets, I think will be pivotal for how long we can see the economy continue to expand and continue to put pressure on inflation.
All right, there is the Fed Chair, Jerome Powell, walking the podium. Let's listen.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. My colleagues and I are strongly committed to we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food, and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa, The Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this, it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand, a lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, and that, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess I just as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
You know, I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, you know, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable with, and consistent with 2% inflation. And you know, we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's a
As to why we saw equities bounce all